Global financial systems process hundreds of millions of transactions daily. Within that legitimate traffic, illicit networks multiply and spread, undetected by standard compliance monitors. The scale of this shadow economy is massive. Experts estimate between 2 and 5% of global GDP, up to $2 trillion, is laundered annually. The 2013 Three Lines of Defense model plots a clean, logical separation between frontline staff, risk management, and internal audit. But as massive transaction volumes slam into the first line, these clean divisions fracture, failing to handle the fast-paced complexity of modern finance. This legacy architecture optimizes for a check-the-box compliance culture. It focuses on the existence of policies on a shelf, rather than confirming those policies actually mitigate threat. A static policy binder offers zero defense against dynamic, exponential financial crime. International standard setters, led by organizations like the Financial Action Task Force, are actively dismantling that check-the-box mentality. They are pivoting regulatory expectations away from technical compliance towards systemic resilience. This shift is codified in the U.S. AML Act of 2020. The law required the Financial Crimes Enforcement Network to establish national anti-money laundering priorities for institutions to incorporate into their control frameworks. Regulators and examiners now judge programs by a demanding metric, demonstrable program effectiveness. Having the policy is assumed, proving it works is mandatory. Effectiveness is evaluated by the tangible results the institution delivers to authorities. Examiners look for the generation of highly actionable intelligence and corresponding asset recovery rates. If a compliance program does not produce intelligence that law enforcement can use, it is failing its statutory obligation, regardless of the pristine paperwork filed internally. To understand why these systems fail, we have to look at the frontline investigators' daily environment. It is an environment defined by massive transaction velocity and strict service level agreements. This pipeline illustrates the pressure. Strict service levels force investigators into a high-pressure mindset. Priority shifts from deep analysis to raw throughput. This triggers operational drift, the systemic decay of documentation and reporting thresholds caused directly by volume pressure. Investigators begin prioritizing speed over precision. They submit incomplete escalation notes and bypass standard verification steps, failing to generate the evidence quality documentation required for central bank examinations. Halting this requires monitoring real-time leading indicators. Tracking documentation decay rates allows supervisors to measure exactly how fast and how far a team is drifting from standard procedure. Operational drift is a systemic vulnerability that compromises the entire intelligence pipeline. Federal examiners view this drift entirely differently than internal management. They do not view an incomplete escalation note or a repeat misclassification as a mere operational mistake or an internal training gap. Under the Bank Secrecy Act, regulators classify these errors as compliance control failures that degrade an institution's ability to identify suspicious activity. To map a solution, institutions must implement rigorous frontline governance tools. This logic tree demonstrates the standardization of an escalation taxonomy, forcing unstructured alerts into predefined mandatory routing rules. Without strict, auditable escalation logic, an institution cannot defend its program effectiveness during a regulatory exam. While operational teams struggle with volume, the threat landscape is evolving. Transnational criminal networks actively exploit cross-border regulatory fragmentation to move illicit funds. This document outlines the common typologies used to drain these funds. Criminals deploy sophisticated schemes like triangulation fraud, peer-to-peer off-ramp abuse, and intense emotional manipulation tactics to bypass standard defenses. These attacks expose the semantic security gap. Traditional alert systems capture numerical triggers, like transaction speed and volume, but they are blind to human psychology and narrative manipulation. The attackers bypass the rigid digital security grid effortlessly because they do not attack the code, they attack the human enforcing the code. High-level financial fraudsters use advanced neuro-linguistic programming techniques. They establish verbal anchors during social engineering phases to induce states of compliance or urgent fear in bank employees. In a recent $4 million wire fraud case, an attacker's artificial intelligence analyzed a CEO's sent folder. It mapped his average sentence length, his use of specific metaphors, and the frequency of his greetings. the system drafted a wire request utilizing syntactic mirroring. By perfectly cloning the CEO's communication style, the request easily bypassed the CFO's standard suspicion filters. As long as compliance systems only monitor numbers, institutions remain defenseless against linguistic and psychological infiltration. To combat AI-driven financial crime, institutions must evolve toward cognitive compliance. Neurosymbolic AI fuses the logic of rigid regulatory rules with deep neural networks detecting behavioral patterns. It applies vector embeddings to convert chat logs into high-dimensional mathematical spaces. Analyzing this geometry allows systems to intercept shifts in communicative intent, from service inquiries to manipulative extraction. Operationally, these sentries detect the synthetic urgency hidden in AI-generated phishing emails, while drastically reducing the false positive rates of traditional transaction monitoring. Cognitive AI analyzes the brain of the transaction, moving compliance from merely monitoring the numbers to understanding the psychological intent behind them. Deploying these algorithms demands rigorous governance. Explainable AI is mandatory. Institutions must prove exactly how a model reached its conclusion to satisfy regulatory defense. This requires upgrading the corporate structure to the 4 lines of defense model. A distinct, active 4th layer is added, incorporating supervisors and external auditors directly into the framework. This 4th layer formally integrates external oversight. It reduces asymmetric risk by ensuring internal audit and external regulators share a comprehensive view of model effectiveness. While the tools and technologies have dramatically changed, the core objective of these institutions remains exactly the same: locking down total financial integrity. Today's compliance professionals architect the bridge between advanced AI pipelines and statutory outcomes, ensuring the long-term integrity of the global financial system.